Thank you very much, James, for conducting so brilliantly the conference. Now it's a turn to regulation. This conference really dealt with regulation and supervision for many years, and then as we emerged from the crisis, we were able to introduce other topics. But this panel really is going to be focused on what the origins of the conference were. So I think our panelists are here already. We have Burkhard Balz. Mr. Balz is member of the board of the Deutsche Bundesbank. Fernando Restoy, who is chair of the Financial Stability Institute in Basel, and who is writing and speaking a lot about very relevant debates. Thank you, Fernando. And we have the governor of the Bank of Spain and chair of the Basel Committee. I think he's here with our CEO, José Antonio Álvarez, who will also join us on stage in a minute. I want to draw your attention to the backdrop that we have here. It's a crop field. We chose it because we see it's a clean picture. It's very productive. It is wide open, and that's really what we look for in the regulatory framework. So hopefully that has a meaning to us all.
Not really green.
Not very green, true, but we've had so much green. We have green still present here, so we try to do a different color this time. Muchas gracias, gobernador. Muchas gracias. Aquí, por favor. José Antonio en el centro, si te parece. Aquí, perfecto. Bueno, I've introduced you already as you were coming down the stairs, and I've said that this is really the panel that goes back to the origins of the conference, right? It's regulation, it's supervision. That's where it all started. So now we have 50 minutes to deal with these issues. There's lots happening, so we have a lot to cover, a lot of ground to cover. I'm going to start with one question to all of you, the same question to all of you, and that has to do with lessons from the crisis. I think we've gone through a very severe crisis last year. We put to the test the regulatory framework that we had created as we emerged from the global financial crisis. And well, all of you here are really, hands-on to that regulatory framework. It would be great to hear from you how you've seen it and how you expect it to change with the current challenges that our sector has. And if you can, please, Governor, we'd love you to start.
Thank you very much, Alejandra, first for the invitation, also for the question. Well, in my case, I have to comment on a recent paper that was published by the Basel Committee, because of course, as you were saying, Alejandra, this has been probably the first test, the first global test that all the regulatory agenda that was modified after the global financial crisis, the first one that we have had. And precisely because of this, the Basel Committee initiated last year an analysis of to what extent this regulatory agenda has worked as intended or not. And we published a preliminary report, and I underline the word preliminary, because of course the crisis is not over, and we will have to finalize this evaluation next year, and we intend to publish an update of this report next year. But I think there are already some preliminary conclusions from this report that are probably relevant. Maybe with one caveat from the very beginning is that, the crisis was completely extraordinary, exogenous to the financial sector, but it is also true that the policy measures, both monetary and fiscal measures, were also extraordinary. And to a certain extent, they have avoided that many of the potential consequences of the crisis to the financial sector have appeared. And this is important to take that into account. But anyway, even taking into account this caveat, I think the results of the empirical analysis that is provided in this paper shows at least two main conclusions. The first one is that all the increase in capital requirements for the banking sector during the last decade has been very helpful in order to deal with the crisis, and there is some empirical analysis in the paper that shows that those banks with higher capital requirements suffer less increases in CDS spreads, for example. They have also lent more to the real economy during the crisis. Even the uptake of the different measures provided by governments was also higher for these banks. And the second, it is also true that we have also some preliminary evidence that the buffers, the capital buffers that were there precisely to be used in a situation like this one, banks were to a certain extent hesitant to use these buffers. No? And again, there is some evidence that those banks that had less room for maneuver, in terms of the distance to the MDA, for example, they tended to lend less. They even reduce rates to a lesser extent than other banks. And this is not related to the capital level, but to the threshold, to these capital requirements. Of course, these are only preliminary results. We don't know exactly why this is the case. Market stigma might be one reason. Low profitability might be also another reason. But still, we have to think about it, and in particular, the discussion on whether we have sufficient releasable capitals has to start, and we have to draw some important conclusions, because, of course, next time the measures taken by governments might not be so important, might not be sufficient. We might need these buffers to be used, and we need that they are used if needed, of course.
Thank you, Governor. And Burkhard, your take on that one.
Well, first of all, thanks again for the kind invitation. To think about that issue, I think what made this crisis somewhat special was that this time around banks were not the problem, but the problem was here that others, of course, caused the issues, and the banks helped to solve the problem. So also rising infection rates affected banks. The pandemic has, from my point of view, no major impact on the operational stability. Or in practical terms, this made it particularly challenging for all of us as supervisors, and Pablo already mentioned that we have to strike a balance between, of course, intrusive crisis modus, and then, on the other hand, to a supporting role of the banks and all of us. Maybe an example for that was last year's discussion on restricting also the dividends. I know that not only in your country, also in my home country, in many other countries all around Europe, this was a big issue. And we all know that we as supervisors encourage the banks to use here the flexibility provided by IFRS 9 to avoid the cliff effects, excessive volatility, and procyclicity in provisioning. So capital buffers create a bridging period, I would say. In bad times, it should be possible to waive requirements to avoid here the deleveraging. And then the functionality on the current capital buffer concept is not really tested before and during the COVID crisis. So what we have seen that there are no significant loan defaults to date. Another thought was that one part of the problem is that banks don't want to use the buffers. That's also the truth, because dividend restrictions came into force. We had seen concerns about own earnings weaknesses, and also concerns about disciplining effects by the capital market itself. So internal control mechanisms of banks often favor deleveraging over weakening the capital base. That means that buffers protect against self-reinforcing destabilization effects, and lowering capital requirements is therefore not really an alternative. I want also be very clear on that. So the European Commission reviews then the macroprudential framework until mid of next year. And of course, then we come to Basel III and the issues around. Some of the Basel III issues are specifically targeted at reducing the procyclical effects such as a buffer framework. For me, it's a main lesson is that sound capitalization is key to keep confidence in the entire banking sector and to maintain the lending.
Thank you, Burkhard. And Fernando, I think from the FSI and BIS, you're certainly doing a lot of work on analyzing the response to the crisis and even also to the question about the buffers and the usability of the buffers. Maybe you'd like to address that too.
Well, I guess you want us now to provide you with a broad overview, right, of the functioning of a regulation, more generally the banking system after the pandemic outbreak, and then we can get into more details if you want. I guess I fully agree with basically the positive assessment of the performance of the banking sector over the crisis. Certainly, they have been part of the solution and certainly not part of the problem, as is often said. And of course, something of that very positive performance had to do actually with a better regulation. I mean, the regulatory reform that was introduced after the financial crisis. At least in two respects, it's clear that the loss absorption capacity of banks have improved markedly in terms of capital, in terms of liquidity as well. And that's obviously very, very important. But as important of that is that the framework has actually adopted this macro-prudential type of angle, which has proven essential, actually, to inform the way regulators should actually react to the pandemic shock. So it has been quite important that monetary authorities, fiscal authorities, macro-prudential authorities, but also micro-prudential authorities understood that the priority after the outbreak was actually to try to minimize the impact of the shock over economic and financial stability. So the priority was clear, to try to facilitate the continuation of credit flows to the real economy. And again, it was not only part of the attitude or the strategy of macro-prudential regulators, but also by micro-prudential authorities, and that has been key. And this is something which is pretty much linked to the Basel III reform. But of course, you cannot waste an opportunity, a good crisis, actually, to learn how to further improve, actually, the framework. And then it's very clear that we can already extract some lessons. The buffer issue, of course, is there. We can discuss that later. I fully agree that we may have identified some possible deficiencies in the functioning of the buffer framework that could actually be improved. Again, we can do it later. I think it's important, the institutional framework. We have learned how important coordination is in that particular situation between fiscal, monetary, macro-pru and micro-pru authorities. That is key. That has proven relatively reasonable, favorable, at least so far. But the game is not over. So we'll see in the pace towards normalization whether this coordination continues actually to the same extent that we have seen previously. If not, again, some reflection about the institutional framework would actually be warranted. And finally, my last message here is that we should not forget, even if we are actually in a conference organized by Banco Santander, the non-bank financial system. This has not worked actually perfectly. We know, we all have in mind the very significant turmoil in March 2020. That helped us to identify some deficiencies in the functioning of both private and public debt markets, the lack of liquidity in stress situations, and that should actually be solved by possible regulatory adjustments. And certainly the performance, the behavior of some non-bank financial intermediaries, in particular money market funds, and we know that actually their behavior was quite procyclical. So something that we started doing after the great financial crisis should actually be followed on. It's not enough what we have done, and certainly additional measures should be introduced in order to increase, to strengthen the resilience of those non-bank financial intermediaries as well. And it's, I think, quite fortunate that the Financial Stability Board has this issue pretty high in its agenda. So let me stop here.
Thank you, Fernando. We can go to the buffers later. Now, José Antonio, you're the practitioner here. You have to run the bank, no, with the backdrop of this
I'm the one that
complicated regulation. You're the one that's regulated.
So when I look backwards to the origin of the crisis, I should say that the first thing that happened when the whole economy went to a lockdown was a good reaction and quick reaction from both monetary and fiscal policies. Yeah? So on the one side, the central bank came along, providing liquidity to the economy. On the other side, different governments start to extend guarantees for keep the lending going in a situation that was far from clear. Yeah, we were entering into a situation in which nobody knew, at least I didn't, and probably the majority of us being in the financial world, we didn't. We were asking the people expert in health, in viruses, in all these things. And we went into a process of keeping the economy going in a situation that has two angles. One was, and I want to stress this because probably we forgot, was the operational angle. So keeping an organization like the one I represent here with 200,000 people, serving the customers in such a difficult situation was far from clear the very first day. Yeah? So we were able to put the organization working from home, up and running, with the capacity to serve the customers in this very difficult moment. So in Europe, so as a matter of fact, the government sustained guarantees, not only in Europe, all around the world, but in Europe particularly. And we were able, and I've been very vocal on this several times, we were able, and we are proud that we were able to channel billions and billions of loans in a relatively short period of time, probably in 8-10 weeks, to keep thousands of SMEs and also small and medium-sized companies, also big companies, going. And these two facts, a good reaction, quick reaction from the monetary and fiscal authorities, and the capacity of the banks, particularly retail banks, to channel all this into the real economy was critical to first, by the time, to address the main issue that was the health issue. Don't forget this, that what we had at the time was a health issue. We need to buy time to keep the economy going, and these were the two things that, in my view, were the most important one at this very difficult time.
Thank you. It was a difficult time, very hectic time. And there were other things happening. And we have here Pablo, the governor, also as chair of the Basel Committee. No? You must be happy that the Basel process has continued. It had a pause of a year, possibly, but it's continued. And I would like you to comment on that. How is that going? That's a very important reform, no, for our sector.
Yes, it is. And it's important that we all acknowledge that it's important that it is applied in full and timely. Basically because, I mean, the main motivation that was behind the agreement at the end of 2017 on this last part of the reform is still there. No? We know that there is still a significant variability on the risk-weighted assets as measured by different banks. And this, of course, affects the confidence of the market on the capital ratios of the banks. So this was the main motivation, no, for this last part of the reform that was approved. We also know, and there was a very interesting paper published by the European Central Bank last year, on which it's very clearly shown that the full implementation of this reform will have significant benefits for the euro area as a whole. And of course, I think the results of this analysis can also be extrapolated to other jurisdictions. Very interesting, by the way, it is only the full implementation, so without any dilution of the content of the agreement, that will provide these positive effects of the reforms. No? And this is why we are defending, from the Basel Committee perspective, of course, that the reform has to be applied. And now that we are considering the implementation in Europe, it's very important that this implementation is done in full and in a timely manner. Maybe I should mention two aspects. Well, many times, in particular in Europe, it is criticized, this agreement, because, well, the incapacity of the agreement to incorporate some of the specificities of the European banking sector. This is not true. And in fact, there was a long process before this agreement was reached, on which, well, more than 10 consultation papers, more than 3 years, and many of the specificities and the comments provided by the banking industry, and in particular the European banking industry, were incorporated. So the agreement is already a compromise. And then second, well, the impact on capital requirements. Well, the agreement as a whole, and if we take the global banking sector, the impact on capital requirements is negligible, although of course we know that for certain jurisdictions, and in particular for Europe, is relatively high. But of course, this is to a certain extent intended. I mean, if there are outlier banks that use in a very aggressive manner internal models, the implications of the implementation of the output floor immediately would lead to have more impact on capital requirements in the future. But this is of course not unintended. I mean, it's in the mere motivation of the agreement, no? And this is of course also important to be emphasized at this stage.
Thank you, and I'm sure José Antonio would like to react to that, and I will take the opportunity to ask you a question that I think underlies many of these regulatory debates, and that might sound a bit provocative, but do you find a trade-off between profitability and capital strength? The governor has given his view very clearly.
Well, I should say mathematically this is exactly true, but having said that, I think it's a mistake to create this dilemma. Yeah, okay. So capital strength is a must for the banks because one of the main assets we enjoy as a banking system is the confidence and the trust of our customers. So for that purpose, solvency and capital strength as a key for the solvency is something that we should be aware of. Having said that, what happens when being solvent, the banks are not profitable or not profitable enough or don't meet the cost of equity? What happens is you are good on one side of the equation, that is the stock of capital. But you are weak on the other side of the equation, that is the flow and the potential access to the capital. And those banks who rely on uniquely in the stock of capital, those banks are weak by definition, because at some point one crisis will come and they have a fundamental problem in their business model. What happens at this time? Whatever is the amount of the stock of capital you enjoy may be destroyed partially or totally, and you are not able, one, to generate new capital because you are not profitable. Second, and most important, you don't have access to the market, because as your business model and your trajectory has shown to the investors, do not meet the minimum requirements to have access to capital. So for that reason, the banks that are really strong are the ones who have a stock of capital that fits for purpose with the risk they have, and the risk, it's important to measure the risk properly and to take into account all the elements of the risk, including the diversification. This is one side, and the other side of the equation is the flow. So, and we have seen this during the crisis. We have seen during the crisis banks that, being under extremely difficult situations, they were able to raise capital from the markets, while others were not able. The main difference was the business model. It's a business model that offer potential future return, or there isn't. And this, to me, is the key. So profitability and capital is not something static. It's dynamic. At some point, the crisis will come. We don't know the nature of the crisis now, and try to guess the next crisis is difficult. Make sure that your business model is profitable, you have enough capital. At that point, you can use the capital or raise capital if needed, provided that you have this.
Very clear, thank you. Fernando, I want to follow up with you on the buffer question, because you've been looking at this, that those buffers were available to be used during the crisis, but they were really not used. No? There was a reluctance to use them. So what could be the solution? What are the kinds of ideas you're thinking about for the future? Because I know you are thinking about it.
Okay, I mean, let me maybe summarize but briefly what the issue of the buffers is. So we have basically in Basel III two different types of buffers. We have some buffers that we call usable, so buffers which are fixed, therefore they are not adjusted over the financial or economic cycle, they are fixed, but banks are supposed to use those buffers in case they have to face adverse conditions with the purpose of, maintaining the credit to the real economy, while at the same time actually preserving minimum capital requirements. But you have a second type of buffers, what we call them adjustable or releasable, those whose formal size is actually adjusted depending on economic and particularly credit conditions. This is the case of the countercyclical capital buffer. So what has happened actually so far after the pandemic outbreak? First is that the size of the countercyclical capital buffer in most jurisdictions around the globe has been small or zero. So there was basically no firepower there. There was no possibility to use that buffer in order to try to foster the supply of credit to the real economy. What happened with the other buffers, the so-called the usable buffers? Well, first, they have not been used, and financial institutions have repeatedly actually told everyone that they don't want actually to use those buffers because they feel that there will be sort of a market penalization if they do so, the so-called market stigma effect. So those are two very clear facts. In addition, we have some statistical evidence. I think the governor already referred to some of it. For instance, we know that indeed there is actually a market penalization for banks with a small headroom above minimum capital requirements. So there is actually, whenever banks actually make use of those usable buffers, and therefore they reduce that actually those headroom, then market actually penalizes that in terms of lower market valuations. And indeed, we know that banks with little headroom also, as the governor said, they lend less, and by the way, they tend to select less risky borrowers. So some subset of borrowers may have more difficulties actually to get access to credit. So you put this evidence together, what is in play? First is that the so-called usable buffers, the capital concentration buffers, are not really playing a meaningful macro-prudential role. Banks do not use them, and they are forced to use. They face pressure. They prefer actually to constrain credit rather than reduce actually capital below the formal size of those usable capital buffers. On the contrast, that if there is a countercyclical capital buffer which is set at the positive level, indeed actually regulators could actually reduce that buffer. By doing that, actually you increase the headroom that banks actually have to lend without suffering a market penalization. So from that point of view, from a macro-prudential point of view, certainly the adjustable, the releasable buffers are much more powerful than the usable buffers. So that will tell you that one option to be considered is actually to put in place a somewhat larger macro-prudential buffer, say countercyclical capital buffer. Very importantly, it will have to be set at a non-zero level in normal times. And once you do that, actually you will have much more possibilities actually just to have a meaningful macro-prudential function, some possibilities actually to foster the provision of credit to the real economy by reducing formal capital requirements, rather than by inviting banks to make use of those usable buffers. That will, you don't want to increase at the same time overall capital requirements. You will have to rebalance that. So you will have to increase the countercyclical capital buffer while at the same time reduce the size of the other buffers. Of course, that will entail a very significant reform of a key aspect of the Basel III framework. We have to be aware of that. also we have to be aware that by rebalancing the instruments in favor of macro-pru and against micro-pru, I mean, you may actually generate some conflicts between micro and macro prudential authorities and between, by the way, home and host authorities. So that implies that, of course, before going in the direction of sort of adjusting or modifying in such a significant way the Basel reform, the Basel framework, of course, you have to analyze pros and cons of these and alternative options. You have to do that by means of trying to accumulate as much evidence as possible, trying to conduct additional analytical studies, something that, under the leadership of the governor, the Basel Committee is committed to do. So hopefully, we will have that analysis completed soon, and on the basis of that analysis, we'll see what the Basel Committee decides in terms of whether it makes sense or not, it is worthwhile or not, actually to go in the direction of such a relatively significant reform.
So this sounds like a Basel IV coming sometime, no? I'm going to switch gears to digital and payments. I don't know if you have any reaction to that, Governor. I see you taking lots of notes, and I don't know if you have to, or José Antonio or Burkhard.
No, I simply agree with what Fernando has just said. No, perhaps the interesting thing from this paper I was mentioning, published by the Basel Committee, is that precisely releasable buffers, so the CCYB, for those jurisdictions that had, before the crisis, a positive CCYB, and they have released this buffer during the crisis, what we have seen, and there is also a very nice paper by the ECB on this, is that once the CCYB was released, the banks have reacted by modifying, reducing, of course, their internal capital targets. Okay? So this means that they have worked. So the releasable buffers have worked as intended. Okay? While this is not the case for the rest of the buffers. And this goes in the same direction that Fernando was emphasizing, no? That if we want to have, and I think we should have, more releasable buffers, well, there are, of course, two ways to do so, just by, again, increasing capital requirements as a whole. You may ask
not a great idea, to be honest.
What he thinks about it, or simply changing the composition. So these are the two options, no, to increase the releasable buffers that we have currently.
Thank you.
Okay, the capital has demonstrated that it's more than enough to couple with a pandemic crisis, pandemic type of crisis, yeah? So come on, Vince.
I was not suggesting that. Okay. I was just simply saying that arithmetically there are only two options.
It's good to hear this. Make me to sleep better. Yeah? Okay.
I think it's going to be a long conversation. We have years ahead of us of intense conversations, I suspect. I'm going to turn now to digital and payments. Burkhard, you have been consistently saying Europe needs a strong payment system, and I'd like you to develop that, because we're in the digital era and lots of things changing in payments, so I'd love to hear from you on that one.
Well, you won't be surprised that will I stick to my view, and I will say that today again, definitely. In Europe, we have, harmonized standards and common instruments really to conduct direct debits and credit transfers. That's definitely true. And in that respect, SEPA has contributed a lot for the European internal market, especially when it comes to the payments area. The good thing is also that we are now talking about payments issues at such a conference, because a couple of years ago, it was not really in the focus of the big debates and big conferences, and that's also good that we have the opportunity today to talk about. However, for everyday payments, there is still at the moment only one thing when you want to pay from one person to another or at your local chain, and this is definitely cash. And when we are talking about payments, we have to think what kind of payments or other payments we do have. And most of the payments we see at the moment in Europe are payments that are by nature national payments, national payment schemes. You have many good examples in Europe. In my home country, it's a Giro card. In other countries, you have in the Netherlands idea, only to name a few. But at the end, you have always the necessity that when it comes to cross-border payments or payments in other countries, foreign payments, you have to rely on the international card schemes. If you haven't a contract by your local bank or your national payment scheme, you have to rely on the international card schemes. And these are card schemes, and we all know that, which are not located, mostly located within our European borders. So this is a big issue. Then, pandemic situation. What have we seen? Of course, we have seen that the e-commerce really got a boost because of the situation. And when we are talking about in payments about the e-commerce, of course, then we have also seen that we have to rely on international providers in most of the European countries. So what will I say? European providers lack definitely at the moment a scale to compete on equal terms with the big international providers. And European payers and also payees are dependent on those providers governed from the outside. And this may not be always in their best interest, we all know that. If we look at examples of unilateral sanctions disrupting the payments or price increases where the domestic payment solution was abandoned, or also extraterritorial regulation affecting us here in Europe. So therefore, I would say truly European payment solutions are needed to enhance, well, also the competition. Definitely, I look here to my colleague on the right. Then to decrease the dependency on payment solutions from outside Europe. Then to deliver payment options tailored, how should I describe it, to the need of the Europeans. And also, as I have been a member of the European Parliament before, also the big issue to limit data usage to the extent necessary for conducting the payment. And that means that European market players should initiate such solutions. They need to be governed by European rules and based on harmonized standards. And this could make use of the instant payment infrastructure that is already in place here in Europe. So to sum up, I personally believe that the European Payment Initiative, EPI, could deliver here a truly European payment solution welcomed by payers and payees alike. And I'm curious whether at the moment the 31 banks and acquirers involved so far decide really to enter the implementation phase soon. And for me, it's absolutely clear, and I will finish with that when we really want to create a pan-European system, we really do need, really at the core also, the Spanish players and banks within.
Thank you, Burkhard. And Fernando, you have been doing a lot of work also in the interplay between all these changes in the payment system, the big platforms, no? How they're entering part of this business very quickly too, and now the central bank digital currencies, CBDCs. Would you like to comment on that, how you see that evolving, all that interplay?
Well, this comes obviously to deal with a very general issue. What is the implications of technological developments for the financial system, potential opportunities, potential risks that this creates, and what should be actually the role of government authorities. We know that in general, the technology brings benefits to the system as a whole. We know that some players, like big techs, for instance, are doing a good job in terms of actually transferring those benefits to their own clients. At the same time, we see that the activity of those big techs actually brings some costs and risks as well. This has to do a lot, actually, with the particular business model those big techs actually run, this leverage they have on data and technological superiority that could actually allow them to build and to appropriate all benefits associated to network externalities. This is also leading to process of market concentration. And market concentration is a problem. It's a problem from the point of view of competition and market stability, but could also be a problem from the point of view of financial stability, because of course at the end of the day you will have an excessive reliance by a number of agents actually on the services provided by a few big tech players, and this by itself increases the vulnerability of the whole financial system. If on the top of that, coming now to the question, on top of that you have that some of those big techs are in the business of issuing their own actual means of payments, then risks go even beyond that, and we are talking about potential risks for actually monetary control, for consumer protection, etc. So we have to think about what is the right policy response. First one, of course, is regulation. That's key. Of course, we now have the debate about what should be the right regulatory approach, whether it's activity-based, entity-based, a combination of both. So the debate which is now out there, we have a clear view about this. We think that activity-based regulation is not enough. We need entity-based regulation because we understand that the risks generated by big techs are quite unique, quite specific, on a very specific business model. So you have to address directly the channels through which big techs could actually jeopardize primary policy goals. So you have to understand actually the business model and define and design the proper regulation in order to address those very specific risks. And by the way, this is certainly the approach taken in several jurisdictions, China for sure, with the adoption of the new financial holding company regime, but also in Europe, with the Digital Markets Act, the Digital Services Act, and to some extent also the regulation on operational resilience. So something is going on in that direction. But of course, the point is that while regulation is key, again, public authorities may need to do something else, because the objective is not only to control the risks, it's also try actually just to benefit from all the positive elements that technology actually brings. So if you constrain the activity of big techs by regulation, as you should do, you have to make sure that there are alternative ways actually to benefit from potential gains in the efficiency of domestic and cross-border payment systems, financial inclusion, etc. And in order to do that, you may need actually to accompany regulation by the provision of some public good by public authorities. This is happening in emerging market economies very extensively. It's happening in Singapore, it's happening in India. And you could also consider that CBDCs, the central bank digital currencies, could be part, if it is well designed and well calibrated, could be part of this public infrastructure that authorities could actually put in place in order to increase the efficiency of domestic and potentially cross-border payment services without having to rely on the activities performed by specific players such as big techs.
Thank you. You've covered a lot of ground there, but there's one focus of attention that I'd like to cover in the minutes that we have, which is CBDCs, I think. Burkhard, you've said that these raise today more questions than answers, and you're probably right, but how prepared are we, financial institutions, regulators, et cetera, to deal with this transformation?
Well, indeed, it's challenging to introduce such a thing like CBDC, because we are here, I would say, in uncharted territory. We have no real role models in the Western hemisphere, and we have only a very few CBDCs or currencies like CBDCs in a live status. There are 65 or even more projects, we are debating that at the moment, globally from colleagues of central banks who are looking for an own CBDC and have, of course, set up those projects. And when we look at our more and more digitalized world, of course, we as central banks have to think about what this does mean for us. We have more than 13,000 private crypto assets. I don't speak here from currencies, obviously, but more than 13,000 around the globe, private crypto assets. And of course, we won't be left behind as central banks. So that's why the Euro system, we all together here in the Eurozone have set up a project for CBDC. It started 1 month ago, 1st of October, and we are now in this investigation phase, which should last for 2 years. So at the end, we have to think about what really the people in a more digitalized world really need. Again, all is about the people. And then, of course, we have to create an own CBDC. Then, of course, Pablo and the colleagues in the ECB Council have to think about if this is the right concept for a European CBDC or a digital euro, as we name it at the moment in the project phase. But one is for sure, we will prepare here an own European digital currency at the moment. This is a very interesting project, I can tell you. Many people involved, and as the CEO of Santander is also here, of course, at your conference, for me is one thing very clear, that we have to create such a CBDC with a private sector. Because at the end of the day, we need the private sector, and we won't split up the twofold system with central banks and private banks with a CBDC in the Eurozone in the future. So that's why we also have now announced a so-called market advisory group, 30 people from the private sector who will advise the project, who will advise the people from the ECB and the Eurozone who are now working in this investigation phase. And I really say at this point, it's good also to have these exchange of views right from the beginning between public sector, the central banks, and also here the private interlocutors, especially the private banks. So at the moment we have many questions. Fernando already elaborated about the risks, of course, and there are many others, also technology, so on. But we will definitely try here to prepare then a concept that, well, the ECB Council and your governor, Spanish governor, will be able then to decide whether we will have then CBDC in the Eurozone or not.
Thank you, and I'm sure we'll be very happy to work together on that one. But let me first turn to Pablo, to our governor, again. You might want to react to this digital conversation, but I don't want to leave the stage before we also go back a little bit to green. I know that the stage is not green right now, but it's a huge challenge and opportunity for our sector. And I'd like to hear from you also how you see it from the supervisor point of view.
Well, maybe, Alejandra, one comment that I can make for both issues is that we need to take financial stability considerations. I mean, when discussing CBDC, for example, it is obvious that one of the main challenges is how to define the features of a central bank digital currency without jeopardizing or creating financial stability problems, in particular in a moment of crisis. And it's not obvious how this can be done, and this is why we are working on it. We are not there yet, and in the next 4 or 5 years we have to work on many issues, including, of course, the technological issues that you were mentioning. But I think this particular issue, I think, is very, very relevant. Okay. And with climate, I mean, the approach as a central bank, a supervisory authority, has on this topic is exactly the same. We know already that climate change and the fight against climate change has the potential to create financial stability problems because of physical risk on the one hand, extreme weather events, for example, they have negative consequences on the profit and loss accounts of the banks. And acting against climate change, all these different policy messages that we are expecting, that we are desiring for governments to take, they also create, of course, financial stability risks that have to be addressed. And why is that? Well, it's simply because many of these measures, what they do basically is to change the relative prices of products or of activities. What we are trying in the end is that some activities reduce their weight in the economies, and others should substitute them. And of course, this will affect also the portfolio of the banking sector. No? So, from the financial stability perspective, what we need is, and concentrated on the banking sector in particular, what we need precisely is to force banks to address this financial stability risk. And the problem, of course, is in this case is that measuring these risks is not trivial at all, and it is not trivial because we don't have precedents that we can look to, also because there might be some non-linearities that are also very difficult to model, also because there is no data. I mean, there are very different reasons why this is the case, and this is precisely why central banks are working mainly, at least at this stage, with a stress test, no? That now they are basically trying to measure in a very imperfect way this risk. At the Basel Committee, what we are also doing is basically to look at the current regulation, both Pillar 1, Pillar 2, and Pillar 3, so meaning the information that is provided to markets, supervisory considerations, and also regulatory framework, Pillar 1. We are trying to define whether there are gaps in this regulation, and once that we have identified, if any, some gaps, and there might be some gaps for sure, we will work on covering those gaps. No? Probably this will be much easier for disclosure in order to complement some other initiatives that are being taken, not only for the financial sector but also for non-financial corporates. But I mean, supervisory guidance and principles could also be, including, of course, the incorporation of the results of the stress test on P2G could be also a potential avenue to be analyzed. And of course, finally, we will also have to consider whether the capital framework is adequate, no, to cover this risk. But of course, there is no commitment right now to make any change, but we have first to analyze the issues deeply before considering any action here.
Thank you.
By the way, just one comment, Alejandra. Of course, the fact that we are focusing on addressing financial stability considerations doesn't mean that it is not relevant for the main purpose of combating climate change, because of course, by doing so, we are also influencing relative prices, no? in the same way that other authorities, public authorities, are doing, for sure.
We know a lot of work and a lot of responsibility for our sector. And before we finish, I'd like to give a final word to José Antonio to maybe wrap it up and see how he sees the sector, our European sector, possibly also in contrast with the US, no? Where banks have shown better valuations and they are also facing these huge challenges. Please.
Before I go to the question, I will address the question. Let me to react to some comments that were made. Burkhard mentioned the European Payments Initiative. We at Santander think that is a good idea, so we are working on this, and we are working on make this happen. Okay, so that's the first idea. On the central bank digital currencies, happy to work with this. Naturally, it brings significant challenges. Fernando mentioned some of those. The governor also mentioned that while this may represent some threats for financial stability, depends on the design, and for sure, this is something that we need to work in the coming years in order to design properly what otherwise we think that is going to be in use in the future, and it provides good services to the customers and improve the payments, all the payments across the system. Yeah? So those are two things that are important to get out of this central bank digital currencies initiative. Finally, well, Alejandra, you asked me why American bonds are, the value of the American bonds is much higher than the European ones, 2 or 3 times, maybe higher in terms of price to book value. The short answer is profitability is much better than ours. So when I go to profitability, we are catching up. So our return on equity now at Santander at least is well above the cost of equity. It's true that the European system as a whole, the profitability, the return on equity is well below cost of equity, and this probably explains what's happening. The question is not the fact that it's there, is why this is the case. If I need to elaborate on this, there are some cyclical factors that are very well known. GDP in Europe has been growing less than in the States. Interest rates are negative in Europe. That is a big drag on the profitability of the banking system, but those are cyclical factors that sooner or later will go away, I hope, rather sooner than later. The other question is more difficult, questions that are more difficult to address are the structural factors. I cannot mention all of them, but it comes to my mind several of them. The first one is having a truly single market. Okay? They do, we don't. The second one is having a capital markets to rely upon on those markets to allow them to originate and distribute the risk that otherwise remains in the balance sheet. This is the second one. The third one, probably, while there is some sponsorized activity in the US that helps the profitability of the banks, particularly Fannie and Freddie then represent a kind of, let's say, capital liquidity subsidy to the mortgage market in the US. So that is significant. So it's, given the size, 7, 8, 9 trillion, I don't remember exactly the number, but it's quite big. And we have another factor on top of those, that is, let's be clear, financial services are more expensive in the US than they are in Europe. So when we look at the net interest income, the US is much higher than it is in Europe. When we look at the fee income, it's much higher in the US than it is in Europe. We were talking about European Payments Initiative, but as a reality today, we have a cap on the interchange fees in Europe, 0.1%, 0.3%, while in the States it easily goes above 1%, that is 3, 4, 5 to 1. So financial services are much more expensive in the US than they are in Europe. In terms of cost to income, that you may say, oh, we are less efficient. Cost to income is always a bit tricky because it has two sides, the cost and the income. You have too much income, you look great, although operationally you are not so great. But cost to income is not that different at this stage. Yeah? So looking from industrial point of view, not only from the financial point of view, it's not that different. So I should, there is several factors there. At the end is profitability. Yeah? So the return equity in European banks, the last number I remember is 6%, and in the States is 13, 14, 15, or something like that. So that's the end of the story, with many reasons behind this.
Thank you very much. Unfortunately, time is up, and we have 2 screens here that reminds us of that, and we have the sun setting also in the photo, so we have to leave the stage. It was really intense, but also very thoughtful. Thank you very much for being here with us today, and I think they deserve a round of applause.